This week is Central Bank Week. On Wednesday, the Federal Reserve will make its decision. The Bank of Japan on Friday, the Bank of England on Thursday, and the People's Bank of China on Friday releases its loan prime rate decisions. In this video, we're going to do deep dives into the data to give you an edge you can't find anywhere else. Let's run the numbers. This week is Central Bank Week and also Inflation Week, as we'll see very shortly. A lot of people, when they're investing in individual stocks or indexes or crypto, they would say, rates, yields, central bank policy, it has nothing to do with me at all. PPIs, CPIs, I just don't care. Those things just don't impact my investments at all. I'd like you to consider a different idea. Interest rates represent the cost of money or the cost of borrowing. Let's just take a way out example. The interest rate suddenly moved overnight to 10 million%. Could you borrow? Of course not. You just couldn't afford that. You couldn't make enough money to pay the interest back, let alone the capital. Therefore, interest rates really matter. They matter to businesses. They matter to mortgage holders, credit card holders, financial institutions, and they also matter in between countries. Let's take the inverse example. Let's say the cost of borrowing, the interest rate went to 0.00001%. That means you could borrow just about anything that you want to borrow, because the cost of repayment is literally zero. How would that impact people's borrowings? Please let me know in the comments what you think. How would that impact stock market valuations? How would that impact capital allocation? What about consumer spending? What about if you had retirement savings? How would a literal 0% return impact retirement savings? You can see interest rates are incredibly important. The purpose of looking at economic data is to see how interest rates could be impacted. Let's go through them. As the financial markets are an integrated system globally, it's important to keep your eye on economic events. All of these times are New York City times. When we see the Eurozone coming out with its core CPI, if that CPI increases, that will be a problem to the Eurozone. That means they will have to increase the interest rates inside the Eurozone. On Wednesday, a raft of CPI-related information comes out in Great Britain, and the FOMC, which is an incredibly important meeting, will occur in the US. It's Central Bank Week all around the world, and on Thursday, the official bank rate of Great Britain will come out. Unemployment claims come out in the US, as do existing home sales. Japan's core CPI year on year will be published, and they will bring out their Bank of Japan policy rate. It's expected to stay at negative 0.10%. On Friday, a very good indicator of consumer sentiment, retail sales, will be coming out in Great Britain. In Japan, the Bank of Japan will have its press conference, and you can see a raft of PMIs coming out for a variety of European countries. Also the US, it will also come out there. You can see it's not just Central Bank Week, it's Inflation Week. We need to understand a raft of past data to understand the significance of these economic releases on interest rates. So let's have a look at the charts. Interest rates and the rate of increase in interest rates is a very important factor to look at. Interest rates have increased in the US from literally 25 basis points to 5.5%, and we can see that the Eurozone interest rates have literally come up the elevator. Japan has been keeping its interest rates at negative 0.1%. Australia's interest rate is starting to curve over. Canada's interest rate is doing the same, as is New Zealand. China's economy has been plagued by problems, especially in the real estate sector. They're trying to stimulate growth by lowering interest rates. The interest rate in the UK has just been exploding. The pandemic, the Russia-Ukraine war, and now OPEC Plus increasing oil prices has led to a major series of inflationary shocks that cause central banks to increase their interest rates. This is a global phenomenon. All economic systems are interconnected. We can see the US core CPI year on year starting to roll over. It's currently 3.35%. Inflation has been slower to come down in the Eurozone, primarily because of a dependence on Russian energy sources. Japan's core CPI year on year remains elevated at 4.3%. Russia has seen a significant improvement in its inflation, and it was above 20%, but it's currently 3.95%. Canadian inflation is coming down. Swiss core inflation has remained at very subdued level. This is just a mere 1.5%. China's core inflation has been reported at 0.8%. We've recently seen a bit of a kick up in UK core inflation. It's currently 6.9%. It did look like it was rolling over, and since then it's come up. Due to the pandemic, massive amounts of liquidity were pumped into the economic systems all around the world. We can see the US central bank balance sheet is starting to roll over, but it's still incredibly large, over $8 trillion. We can see China's central bank balance sheet dwarfs that of the US at $41.684 trillion. Stimulus is pouring into the economic system to support the housing crisis. The balance sheets of different countries can give you an insight into monetary policy, that is, control of the money supply. Here we can see Germany's central bank balance sheet coming down. This is called restrictive monetary policy or tightening. We can see the same in the US, but when we look at Japan's central bank balance sheet, it is loose. That means it's increasing. This is to stimulate the economy. Australia's central bank balance sheet is starting to curl over. Canada's balance sheet has been restrictive for some period of time. When governments pile in money in their central bank balance sheets, that means they're stimulating the economic system. When they take money out, this means that they've got restrictive monetary policy. They're trying to restrict the amount of liquidity inside the system to drive asset prices down. Increasing interest rates put company valuations under pressure. Increasing interest rates causes risk on assets to devalue, primarily due to the discounted cash flow models that underpin corporate valuations. What we can see here in the US economy, just in the last trading session, we can see the S&P 500 futures are coming down. The Nasdaq is coming down. The Dow coming down. Russell 2000 is coming down. The US markets lead the world. If we see the US markets coming down, there's a very good probability that other markets will be following. The DAX is coming down, as is Japan's Nikkei index. But of course, Japan is closed for a holiday today. The Hang Seng in China is coming down, and the ASX 200 came down as well. Looking at Forex pairs gives us an incredible insight into how central bank policy will play out. Right now, we can see the DXY, the DXY, exhibiting a lot of strength relative to the fiber, the euro dollar, exhibiting a lot of weakness. Looking at pure economic data won't help you to understand where the support and resistance levels are. That is, where smart money is buying and selling. That's why we have the CTKS method indicator. We can see that when we look at the euro, it was caught by safety nets and has reversed price. It's currently caught in a channel in between 106.57 and 106.75. If we break out, we're going back up to that 107.26. If we break down, we're going to the lower level around that 106.32. And we can see the dollar yen, the gopher, just retracing slightly. The loonie is continuing to show weakness, as is the cable, the pound dollar. The one looks like it's finally turning the corner. The Aussie and the Kiwi are stuck in limbo. At the present time, it's important to understand the relationship between Forex, stocks, commodities and crypto. When the DXY has been spiking, it's been putting a lot of negative momentum across the other markets. All of these factors and more impact your investment and trading decisions, but you may not be aware of it. Interest rates fundamentally change investment allocation. All markets are intercorrelated and interdependent. This means that we need to look broadly to understand if our investments or trades are on the right track. Because all markets are intercorrelated and interconnected, what happens inside the stock market will also happen inside crypto. Whilst I'm recording this video, Bitcoin has been spiking up. It's currently 27,202. As Bitcoin spikes up, it means no alt can escape Bitcoin's gravity. They're starting to spike up too. There's a rule inside the masterclass: no alt can escape Bitcoin's gravity. As Bitcoin is spiking up, what's happened to Ethereum? It's spiking up. What about BNB? You got it. XRP is also coming up. ADA is coming up. Doge is coming up. Solana, Tron. DAI is a stable coin, so we won't worry too much about that. Matic, Litecoin. You can notice a little bit of inversion with TON. TON has been doing incredibly well as Bitcoin was in the doldrums. The greatest gainers, top 100 past 24 hours, eCash, Link, Stacks, Rose, Casper, BSV, Injective and Bitcoin Cash. In tomorrow's video, I'm going to share some Bitcoin Cash trades. Those trades were made at SLs using the method service. The greatest losers, top 100, past 24 hours, Maker, TON, Carver, IOTA, Leo, XDC, EGLD, VET. We covered off a lot of economic and other data at the start of this video. The reasoning and logic behind that was, inflation looks to be peaking. You've seen the charts that show how restrictive monetary policy is worldwide, and how aggressively central banks have been raising interest rates. We've been seeing that interest rates look like they've reached their peak. Therefore, the probability was that interest rates, the US 2-year, the US 10-year and the DXY can start to go down. That will create risk-on activity. We're seeing this play out in crypto right now. Tomorrow's video will be a very practical video. I'm just going to turn on the CTKS method service indicator, and I want to show you that tomorrow that I was buying at structural levels and selling at structural levels, and I show you tomorrow how that went. The CTKS method shows where the true market structure is from a resistance level, that is the ceilings, and a support level, which is literally the floor. You can see right now in Bitcoin Cash that Bitcoin Cash found its floor and found its ceiling. It doesn't mean it can't go up further, but it has to get through this particular level at 221 and 20. We have a degree of underpinning support, and we have much further, stronger support below. If you've been buying and selling with the CTKS method, please let me know in the comments. I would imagine you've been doing quite well. What you will find when you look at those structural support and structural resistance levels, you can use them as buy and sell levels to synchronize yourself in with the market. If you would like to see those structural levels, please visit the CTKS method service. The Foundation membership is closing very soon. If you'd like to know more about how all the world's markets work as one, Perperatum has very kindly offered a CTKS partial masterclass scholarship. You can apply for the scholarship through the link in the description of this video. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again tomorrow. Bye for now.